right now there has to be an obligation to the entity. Your company has to pay something, do something, or abstain from doing something beneficial. Yeah, so see here, a present obligation of the entity to transfer an economic resource as a result of past event. There will be some past event. For example, you purchased 10,000 worth of goods, yeah, and you didn't pay. Then you have a present obligation to pay that person, pay your supplier. Yeah, so that is what the past event is. You purchase those goods. Yeah, now the present obligation is you have to pay in somewhere in future. Yes, and what you have to pay? You have to pay him cash. So transfer an economic resource. So that economic resource will be money, the cash you have to pay in future. Yes, so you're understanding? Yeah, so liability is a what? A present obligation of the entity to transfer an economic resource to do something as a result of past event. Yeah, it is a claim of outsiders on total assets of the company. Yes, if you owe money to your supplier, then that supplier, that creditor, he will have claim on your total assets of the company. Okay, so that's what a liability is. Clear? It's just an obligation, financial obligation of the entity to transfer an economic resource as a result of past event. You purchase goods on credit, yeah, you didn't pay the money, so now you have to pay. So that's an obligation. What you have to pay? Cash, economic resource, something you have to give or you have to do as a result of past event. Past event is you purchasing the item, yeah, the goods. Clear? So that's what a liability is. Yeah, now that person, that creditor, will have the claim on your assets of the company. Yeah, the asset means the cash or whatever it is, but it will have the claim on total asset of the company. We'll say total assets. Okay, that's what a liability is. Then we have to see what equity is. Equity or capital. Now what does this mean? See here, it's very simple. Capital is the money that is invested by the owners of the business, right? Whatever money the owner brings into the business, that's called capital. Simple as that. But now you will be wondering, why do we have two names over here? You are saying equity or capital. Why two names? That's because it depends upon the different types of organization. If it's a simple partnership business, there will be few owners, right, who will bring in the money, and we can just call it A's capital, B's capital, like that. Yeah, whoever has brought the capital. And then if it's a sole proprietorship business, then we can just call capital. Simple as that. Yeah, but now why am I saying equity? That's because if it's a company, then in company we don't have few owners. No, we have thousands and hundreds and thousands of owners, right? Shareholders. We call them shareholders because there in company the capital is divided into small units of shares. Yeah, so that's share capital. Yeah, so it may be equity share capital or preference share capital, as the case may be. So that's why we call it equity. All right, it's just different names, but the concept, rule and meaning is same only. Okay, see the meaning over here, it's same only. Okay, whatever money that is brought in by the owners of the company, that's called capital. Yeah, either it's just capital or equity share capital or preference share capital. Simple as that. Okay, don't worry. So see the technical definition over here. It is the residual interest in the total assets of the entity after deducting all its liabilities. Yeah, so why is it called residual interest? Because the equity, the owners, what do they get? They get whatever that is left, right? Whatever that is left, that is what they get. Okay, see here, when the company wounds up, what the owners will get? The owners will get whatever that is left. Okay, first the liabilities will be paid, and then their capital will be paid. So that is what is meant by residual interest. They have a claim. Yeah, the owners, it is the claim of owners. If someone asks you what is capital, then the technical definition would be, it is the claim of owners in the total asset of the company after deducting all its liabilities. Why am I saying after deducting all its liabilities? Because whenever, if you remember the definition of liability, yeah, they also have a claim, the claim of outsiders. We have to pay to liability holders, right? Obligation, we have an obligation, we have to pay something, do something. So that has to be done first, and then the claim of owners will come. Okay, so whenever there will be a liquidation or the company will wound up, first payment will be done to the liability holders and then to the owners. So that's why these people, the liability holders, will have first claim, these people, owners, will have second claim.